Today I'll show you a real-life example step by step of one of my properties, and by the end of this video, you'll be fully capable to calculate and understand the return on investment, or ROI. So make sure to stick around until the end, and you'll be all set to do it on your own. Real estate is a great way to build wealth and achieve financial freedom. But to succeed, you need to understand the concept of ROI. It is a metric that every real estate investor should understand. It helps you evaluate the profitability of real estate investment and whether it's worth your time and money. ROI is a measure of how much profit you make, expressed as a percentage of the initial investment. In real estate, it's calculated by dividing the net profit by the total cost of investment. So there are four metrics when we try to figure it out, our total return on investment. There is the cash flow, the principal of the mortgage being paid down, the passive appreciation of the property, and the forced appreciation of the property. The cash flow is the net operating income minus the debt. And if you need more details on cash flow, you can click in the video above for a full explanation. The principal of the mortgage being paid down is the portion of the mortgage that is not the interest collected by the bank, but the actual amount of money that is going towards the original loan. For example, if you're getting a mortgage for $100,000 and your monthly payment is $1,000, out of the $1,000, $600 is interest and $400 is principal, meaning that the next month you don't owe $100,000 anymore. You owe $100,000 minus $400. You've already paid in principal, which is equal to $99,600, and so on every month with a slightly different amount since the interest is compounded. There's loads of mortgage calculator online that you can use to figure this out. Next is the percentage of how much a property is worth year over year passively. So for example, the real estate market that you are in had a 5% appreciation rate on average over the last few years, which is fairly typical in real estate. But to be conservative, we'll use 3%, knowing that it is below average. And lastly, is the forced appreciation that happens when you put some extra money initially to renovate a property and it's now worth more. For example, if you buy a house for $300,000 and you are adding $25,000 in upgrades, the house is now worth $350,000, leaving you with $25,000 in profit or adding value. Therefore, you forced the appreciation. So what you need to know is the total amount that you have invested and what is the yearly yield. In general, when we are talking about yields or interest, it's always calculated on a yearly basis. So you'll need to multiply by 12 your monthly income and expenses. So here's a real-life example of a property I bought in downtown Toronto. This property is a multi-family with 3 units, and it was purchased for $984,000. So we needed 20% as a down payment, or $196,800. In Toronto, you have also something called the land transfer tax, which equals to $32,310. And lastly, $4,000 for closing costs. There was no renovation needed on this property, so there's nothing to add there. So the total investment was $232,930. The monthly rent is $5,800, or $69,600 per year. The expenses are $933, or $11,196 per year. The mortgage is $3,535, or $42,420 per year. Cash flow on this property ends up being $15,984. So for the principal paydown is the monthly mortgage payment minus the interest. That equals to $15,107 per year. The passive appreciation is 3% of $984,000. That equaled $29,520. And there'll be nothing for forced appreciation on this deal. So if you add the cash flow, the principal of the mortgage paydown, and the passive appreciation, you'll get an ROI of $60,611. You divide that by $232,930, that was our original investment, and you multiply it by 100. You'll get a 26.02%. And this is how real estate investors are getting above 20% return on their money, and you are also able to grow faster. Now, I've heard people tell me in the past that property don't always go up in value, and that is true only in short term. But real estate is a long-term investment, and over a long period of time, real estate always goes up. But even if I bought this property and the value will never go up for whatever reasons, as long as the house is rented and between the cash flow and the mortgage principal being paid down, my ROI will still be over $31,000 or a 13.34% return on my investment, which is way above average for any low-risk investment out there. And when the value of the property goes up finally, that's the cherry on the cake. Make sure to subscribe to my channel and hit the notification bell button so you can stay up to date on my latest video and you can keep adding the tools necessary to your investing success. By maximizing your ROI across all your investment like crypto, stocks, real estate of course, you are guaranteeing the growth of your portfolio. That's why once in a while, it is a good idea to check if your investments are doing as well as you hoped. And if not, you need to let go of your poor performing assets and add to the ones with the best ROI. I hope you like this video and that you have now the confidence to assess a deal in minutes.